The Federal Reserve just did exactly what we feared they might do. After finally giving us some relief at the end of 2025, Jerome Powell and the Fed have officially hit the brakes on interest rate cuts, holding the target rate steady at 3.50% to 3.75%. Wall Street is divided. Everyday consumers are frustrated. And today, I'm going to explain why this wait-and-see approach might be a massive mistake. If you think the Fed holding rates steady means things are staying the same, you are wrong. Doing nothing is actually making things tighter. Here is exactly why the Fed's pause is dangerous, and why the rate cuts must continue. First, let's look at the Fed's official playbook. Why did they stop cutting? The short answer: they got spooked. Even though inflation has come down significantly from its peak, the latest data showed it getting a bit sticky right above that magic 2% target. Combine that with an economy that actually grew at a decent pace in the fourth quarter of 2025, and the Fed decided they had the luxury of time. The hawks on the committee basically said, let's not declare victory on inflation too early. But here is where the Fed's logic starts to fall apart. There is a massive, hidden danger in this pause, and it's called passive tightening. To understand it, we need to look at real interest rates. Your nominal rate is what the Fed sets. Right now, let's call it 3.5%. But the real interest rate is the nominal rate minus inflation. Let's say the Fed holds their rate flat at 3.5% for the next 6 months. But during those 6 months, inflation continues to slowly drop. Because inflation is falling while the Fed's rate stays the same, the real cost of borrowing money is actually going up. Think of it like driving a car up a hill. If you take your foot off the gas, you might not be hitting the brakes, but gravity is going to slow you down anyway. By holding rates steady while inflation falls, the Fed is accidentally squeezing the economy tighter every single month. And that squeeze is showing up right now in the labor market. Official unemployment is hovering around 4.4%. Historically, that's still low. But the Fed doesn't seem to be looking at the trend. Hiring has slowed to a crawl. The quit rate, which tracks how confident people are to leave their jobs for better ones, has tanked. Job openings are drying up. Here is the golden rule of the Federal Reserve. Monetary policy operates with a 12 to 18-month lag. The pain we are feeling today is from the rates they set over a year ago. If the Fed waits to resume cuts until unemployment officially spikes to 5%, they are already too late. They'll be cutting in a panic to fix a recession, rather than cutting to prevent one. And finally, we have to talk about the American consumer. You, me, the people who actually keep this economy running. The consumer carried this economy on their back in 2024 and 2025, but the excess savings from the pandemic era are gone. Credit card delinquencies are ticking up. Auto loan defaults are rising. And the housing market is still practically frozen because mortgage rates haven't dropped enough to get current homeowners to sell. We need rate cuts not to stimulate a massive boom, but simply to lower the crushing debt service burden on everyday families before things snap. The bottom line? The Fed's January pause might look prudent on paper, but it's playing a dangerous game of chicken with the labor market and consumer debt. To secure a true soft landing in 2026, the cuts must resume, and soon. Most analysts are betting we see another cut by June, but the longer they wait, the harder the landing will be. What do you guys think? Is the Fed behind the curve again, or are they right to be cautious about inflation? Let me know down in the comments. I read every single one. If you found this breakdown helpful, hit that like button, subscribe for more financial deep dives, and I'll see you in the next one.